A guy named Marcus walked into a dealership last year, approved for a car loan in 20 minutes, drove home feeling like he won. 3 years later, he realized he paid $6,400 more than he had to, not because the car was overpriced, because of what happened in that finance office. Here is exactly what to do before you ever set foot on a lot. The finance office is the most profitable room in any dealership. Not the showroom, not the service bay, the back office where they hand you a stack of papers and offer you a bottle of water while you sign. The average dealership makes between $1,500 and $3,000 per vehicle in that room alone, sometimes more. And most of that money comes directly out of your pocket through a mechanism most car buyers have never heard of. It is called dealer reserve, and understanding it is the first thing you need to do before financing anything. Here's how it works. When you finance through a dealership, they don't actually lend you the money. They act as a middleman between you and a bank or credit union. The lender gives the dealer what is called a buy rate, which is the lowest interest rate the bank is willing to accept for your credit profile. The dealer then marks that rate up, sometimes by 1, 2, even 3 percentage points, and keeps the difference as profit. If your actual rate should be 5.9% based on your credit, and the dealer tells you it is 7.9%, you never know the difference. The paperwork shows 7.9%. You sign, they pocket the spread for doing nothing except handing you a pen. On a $35,000 car loan over 72 months, the difference between 5.9% and 7.9% is roughly $2,600. That's a vacation. That's 6 months of groceries. That's money that evaporated because you walked in without your own financing already secured. This is not illegal. It's not even hidden. It's just standard practice that nobody explains to you before you sit down. So here is what you do instead. These are the 5 steps to complete before you ever set foot on a lot. Step 1. Pull your credit report and know your actual score before anyone else does. Not an estimate, not a guess. Go to annualcreditreport.com and pull your full report from all 3 bureaus. Then check your FICO score, specifically your FICO Auto Score 8, which is the version most lenders use for car loans. Many people walk into dealerships and let the finance manager tell them their credit is, quote, just okay, and they qualify for a higher rate. If you already know your score is 720, you know you're in prime territory and should be paying prime rates. If your score is 680, you know exactly what bucket you fall into. The dealer cannot move you into a worse category if you already have the data. Step 2. Get pre-approved through a bank or credit union before you shop. This is the single most important move you can make. Call your bank. Call a local credit union. Go online to a lender like PenFed or Lightstream. Get an actual pre-approval letter with an actual rate. Credit unions in particular are aggressive on auto loan rates because they're not-for-profit institutions. The national average credit union auto loan rate has historically run 1 to 2 percentage points below what big banks offer and 2 to 4 points below what dealerships charge when they mark up their buy rate. When you walk into a dealership with a pre-approval in hand at 5.4%, you have created a ceiling. The dealer now has to beat that rate or lose the financing entirely. Suddenly, you are not begging to get approved, you are offering them a chance to earn your business. Step 3. Separate the car negotiation from the financing negotiation. This is where most buyers collapse the deal into one conversation and lose twice. Dealerships are trained to blend the monthly payment into everything. They will ask how much you want to pay per month, stretch the loan to 84 months to hit that number, and hide the true cost inside a longer term at a higher rate. A $40,000 car at 8.9% over 84 months costs you $52,800 total. The same car at 5.4% over 60 months costs you $45,500. Same car, $7,300 difference, purely from loan structure. Negotiate the purchase price of the car first. Get that number agreed upon and in writing. Then, and only then, talk about how you're paying for it. If they refuse to separate the two conversations, that is a signal. Step 4. Know the invoice price of the vehicle before you negotiate anything. The sticker price on the window, the MSRP, is not the price. Invoice is what the dealer paid the manufacturer. On most vehicles, there is also what is called holdback, which is a percentage of MSRP that the manufacturer pays back to the dealer after the sale, typically between 1 and 3%. This means a dealer can sell you a car at invoice price and still make money. Tools like Edmunds, TrueCar, and Consumer Reports give you invoice pricing for any vehicle. When you know the dealer paid $31,200 for a car they're asking $34,900 for, and you know holdback adds another $700 to their side, you are negotiating with full information instead of hoping they're being honest. A guy named Derek spent 2 hours negotiating a truck down from $48,500 to $46,200. He felt like he won. He never checked the invoice price, which was $43,100. The dealer made $3,100 on the car alone, then made another $1,800 on the financing markup. Derek left thinking he got a deal. He paid $4,900 more than he needed to. Step 5. Understand add-ons and know which ones to decline by default. After the price and rate are agreed upon, the finance manager will present a menu of products: extended warranties, paint protection, gap insurance, tire and wheel protection. These products are almost always marked up significantly above what they are worth and often available cheaper elsewhere. Gap insurance, which covers the difference between what you owe and what the car is worth if it gets totaled, is a legitimate product for anyone financing more than 80% of a vehicle's value, but the dealership will charge you $800 to $1,200 for it. Your own insurance company will often add gap coverage for $30 to $50 per year. That is a $600 to $900 difference for identical protection. Extended warranties have similar markup. If you want one, buy it from a third-party provider or negotiate the price separately. The default answer to every add-on should be no, unless you have a specific reason to say yes and have checked the price elsewhere. Now here is the part most people skip and pay for later. If you have already done all 5 of these steps and the dealership still comes back with a financing offer, you need to do one final comparison before signing anything. Take their rate and your pre-approved rate and run both through an auto loan calculator. The total interest paid number, not the monthly payment number, is the only figure that matters. Monthly payments are the dealership's favorite way to obscure the true cost of a loan. Stretching 48 months to 72 months drops your payment by $180 and adds $4,200 to the total cost. Always calculate total cost. The psychology the dealership is counting on is that you are emotionally invested in the car by the time you reach the finance office. You've test-driven it. You've imagined it in your driveway. Your brain has already started treating it like yours. That emotional state makes you less likely to push back on the financing terms, less likely to walk out, and more likely to sign quickly. This is not an accident. It is the design. The 2 to 4 hours spent in the showroom before you ever reach the back office is part of softening your resistance. Walk in pre-approved, knowing your credit score, knowing the invoice price, with a plan to negotiate purchase price and financing separately. Now you're not a customer who needs approval. You're a buyer with options. The dynamic changes completely. The goal of every step in this process is the same: remove the information asymmetry. The dealership does this every day. You do it once every 5 to 7 years. That gap in experience is worth thousands of dollars to them and costs you exactly the same. The only thing that closes that gap is doing this work before you walk in, not after you have already signed.